All right, get ready because the US tax code just got a major shakeup and it could mean some really big changes for your tax return this year. It's all because of a new law called the One Big Beautiful Bill Act, or OBBBA for short. So, what does this actually mean for your wallet? Let's break it all down.
And look, we're not talking about a few small tweaks here and there. We're talking about brand new deductions and credits that have the potential to put thousands of dollars right back into your pocket. So the big question is, are you eligible? And how do you claim it? That's exactly what we're going to figure out together.
Here's the game plan. We'll start with what this new law actually is. Then we'll dive into the really good stuff, the new tax breaks for workers, families, and seniors. We'll also have to talk about what got cut to make these changes happen. And I promise I'll leave you with a super simple action plan so you know exactly how to claim your share. So first things first, what in the world is the One Big Beautiful Bill Act? Well, to put it simply, it's a massive federal law that's rolling out a whole bunch of new tax and spending policies. And some of the biggest changes are hitting our individual income taxes starting this year. You know, this all happened pretty fast. The bill was introduced last May, it flew through Congress, and was signed into law on July 4th, 2025. The new rules officially kicked in on January 1st of this year, which means they apply to the tax return you're going to be filing in early 2027. All right, let's get to the good stuff, the new tax breaks. The first big category is aimed squarely at American workers, with 3 major new deductions designed to help you keep more of the money you earn. First up is a huge one, especially for anyone in the service industry. Under this new law, if you're a tipped employee, you can now deduct up to $25,000 of your qualified tips from your taxable income. For millions of people, this is a total game changer. Now, there are a few important details you've got to be aware of. To qualify, you have to work in one of 68 specific jobs that the IRS has listed out. There are also income limits. The benefit starts to phase out if you earn over $150,000 as a single filer. And definitely keep this in mind. This is a temporary break. And right now, it's set to expire in 2028. Next up, overtime pay. The new law lets workers deduct up to $12,500 of their qualified overtime income. And if you happen to be married and filing jointly, that number doubles to a pretty impressive $25,000. So what exactly counts as qualified overtime? This is a really key point. The deduction doesn't cover all your overtime pay. It only applies to the extra half in your time and a half pay. And just like the tip deduction, it has the exact same income phase out. And, you guessed it, it also expires in 2028. And the third major break for workers is a brand new one for car owners. For the very first time, you can now deduct the interest you pay on a car loan up to a maximum of $10,000 a year. But as you can imagine, there are some important rules here. Your vehicle has to be new, and it has to be for personal use. And here's the kicker. It must have its final assembly right here in the United States. You can actually check this yourself by looking at the vehicle's label or using the VIN decoder on the National Highway Traffic Safety Administration's website. This deduction also has an income cap, and it expires at the end of 2028. Okay, so moving on from workers. The OBBBA also includes some pretty significant new benefits for 2 other really key groups, families with children and our senior citizens. Let's start with seniors. The law creates a brand new senior bonus deduction. So if you're eligible, you can now deduct an additional $6,000 right off your income. And what's so great about this is that the new $6,000 deduction is on top of the existing standard deduction that seniors already get. So if you and your spouse are both over 65, that's an extra $12,000 deduction. And you can take it whether you itemize or not. Just like the others, it does phase out at higher incomes, and yep, it's also temporary for now. Now, for families, the child tax credit also got a nice little boost, going up by $200 per child to a new max of $2,200. But here's the crucial difference. Unlike all the other new breaks we've talked about, this change is permanent. So what does that actually look like in the real world? Well, this simplified example shows a family with 5 children. Even though their marginal tax rate is higher, that much larger child tax credit under the new law means they actually pay less in taxes overall. Remember, a credit is a direct dollar-for-dollar reduction of the tax you owe, which is why it's so powerful. Now, you might be thinking, this all sounds great, but what's the catch? Well, to pay for all these new tax breaks, something had to give. Let's take a look at the other side of the coin, the deductions and credits that got eliminated.
This is a really common thing in major tax legislation. To make the numbers work, lawmakers will often trade new benefits for old ones. So while a lot of taxpayers are going to come out ahead, some of you might find you can no longer claim deductions you've relied on for years.
So here's a quick rundown of some of the most popular breaks that are now gone for 2026. Some of the big ones are the credits for clean energy, like if you bought an electric vehicle or installed solar panels. Also gone is the home office deduction for employees and the write-off for work expenses your boss didn't pay you back for. And finally, you can no longer deduct tax prep fees, most moving expenses, or that personal exemption for yourself and your dependents. So we've covered what's new, we've covered what's gone. Now for the final and, let's be honest, the most important question. How do you actually claim these new benefits on your tax return?
The one thing you have to remember is this. The IRS has created a single, brand new form for all of these deductions. It's called Schedule 1A. This is your magic ticket. This is where you'll report your deductions for tips, for overtime, the senior bonus, and your car loan interest.
And the process itself is actually really straightforward. First, you'll calculate the amounts for all the new deductions you're eligible for. Simple enough? Second, you'll fill out that new Schedule 1A. From there, you just attach that form to your main Form 1040. And finally, you file your complete return before the tax deadline. 4 simple steps and you're done. And hey, don't just take my word for it. The IRS itself has stated that the changes from this new law are, and I quote, significant. This isn't just a minor update, folks. It's a fundamental shift in the tax landscape that could affect millions and millions of taxpayers. So here's the most important takeaway from all of this. While these new breaks offer some amazing savings right now, most of them are temporary. They're set to disappear in just a couple of years. It's fantastic to take advantage of them while you can, but it also raises a really crucial question for your future. Is your long-term financial plan ready for when they go away? That is definitely something to think about.